everyone, welcome. It is Michael here with Offshore Citizen. I am here in this lockdown in Bulgaria in what seems like it has lasted for the last year, although I think it's about a month or so. And I did manage to get a haircut today. We're going to talk today about the subject of non-resident companies. And where this comes relevant is I was talking to somebody the other day. We were discussing different structures for them, etc. And I happened to mention something about Cyprus. And they said, well, Cyprus has tax, doesn't it? And it's like, well, yes, Cyprus has tax, but in Cyprus you have the ability to have a non-resident company. And so I figured I would discuss, for those of you who aren't familiar, what the deal is with non-resident companies, how that can sometimes be beneficial, how it's historically been a loophole where it's not, and things like this, okay? So here's the basic premise. Normally, in most parts of the world, when you form a company in a country, that company is tax resident in that country, meaning that country is going to apply its tax rules to it. Now, once in a while, that can be overridden by an applicable tax treaty, so it will be tax resident in the jurisdiction, say, where it's managed and controlled, as opposed to where it's registered. But generally speaking, this is the case. However, it is not the case for all types of companies and for all jurisdictions. Okay, so historically, there were three main jurisdictions in Europe where this was relevant. They were Ireland, Gibraltar, and Cyprus. Okay, so in these countries, basically, if you look at, and you can watch our video on corporate residency or on tax residency, I remember we separated out for two, but anyway, on tax residency, and you can understand that where a company is tax resident, the tax rules of that country apply, okay? Well, what happened was, this is normally determined by primarily two things. One is where it's registered, place of registration, or where it's managed and controlled, or both. Now, there's some little nuances about that, like how do they determine management and control? Once in a while, it's based on where you have a permanent establishment, and some of these different things. But 90% of the world, at least, probably 95% of the world or so, uses one of these two standards, or usually probably even about 70% of the world uses both. Meaning, hey, it's resident where it's managed and where it's registered, and if it's not registered there but it's managed and controlled there, then it's still tax resident there. Okay, that's usually the criteria. So places like Canada, Australia, Germany, UK, Japan, run down the list, are typically on that standard. Okay, it's common in, say, Eastern Europe and some places like that. So for example, I'm in Bulgaria. Bulgaria only applies a place of registration rule, meaning that you can have a foreign company that's registered, say, in Hong Kong, that you manage and control from Bulgaria, and it's not Bulgarian tax resident. Okay, and again, so this is fairly common in Eastern Europe and in a few other places. Okay, well, what's possible is that you have countries where it is only based on management and control. Okay, and so as I mentioned, the three common ones that we would look at historically, where this was kind of an explicit idea, were Ireland, Gibraltar, and Cyprus. Okay. What were the consequences of this? Well, Apple, for example, applied this where they would have a company that was resident nowhere, okay? So the way they did that was they had a company that was registered in Ireland, but managed and controlled in California. The US uses only registration rules. So in other words, management control doesn't apply. And so they would tell the Irish government, well, this company is not Irish tax resident because it's managed and controlled in the US. And they would tell the US government, well, this company isn't US tax resident because it's registered in Ireland, and it will be tax resident nowhere, okay? Now, Ireland closed this rule basically in 2019, that it has to be tax resident somewhere else, and if it's not tax resident somewhere else, then it's going to be tax resident based on place of registration in Ireland. As a result, Apple moved their main thing to Jersey, okay? And we'll talk in a minute about Jersey and some of these other places. Well, it still is true in Cyprus and in Gibraltar. Okay, so Gibraltar has a headline tax rate of 10%. Cyprus has a headline tax rate of 12.5%. Okay, and so people will say, oh, hey, my company, it's going to be taxable at 12.5%, right? No, not necessarily. If it's not managed and controlled in Cyprus, you could have a Cyprus non-resident company, and it's not subject to Cyprus tax. Now, does that mean that it's zero tax? No, not necessarily. It could still be taxable where it is managed and controlled, right? But at least you don't have to deal with Cyprus tax. Now, you still have to deal with Cyprus tax filings, or like annual filings and everything that goes along with that. but you don't have to necessarily pay tax. And so this is a subtle nuance of pointing out, saying, hey, look, I can have a company that is registered in Cyprus, but it is not a Cyprus company for tax purposes. And so this is, something to specify. When you're forming a company in Gibraltar or in Cyprus, historically, we would always say, hey, we want to form a non-resident company there. Now, local service providers don't really like this because they would rather have you provide, rather provide services there, and they'll make a story where they'll say, oh, well, if you do that, you can't take advantage of the tax treaties, which is true. So under the terms of the tax treaties, it will only apply to resident companies, okay? So if you're not a Cyprus tax resident, then you don't get take advantage of their tax treaties. The truth is, very often these tax treaties really don't matter too much for you at all, but sometimes they do. So that's something to play around with, okay? Now, the thing that goes along with that is you're gonna see a lot of places have IBCs, international business companies. So for example, you would have that in Barbados, okay? Now, a IBC is basically a non-resident company. So basically what they've done is they've created a class of company in that country. And this goes for, Anguilla, Nevis and St. Kitts, Dominica, you start running down the list. And a bunch of these, you'll notice actually when you look at their domestic legislation that they're not zero tax jurisdictions. So some of them are, such as Bahamas, Cayman Islands, things like this. But some of the others aren't. Some of them actually do have local taxes. But the IBCs are not subject to tax. Belize is another one, right? So you get a Belize IBC. And the whole idea is basically they're saying, hey, this is a non-resident company. You cannot manage and control, or rather you can't run operations, you can't do business locally in that country. And the reason they do this is to prevent their locals from going and forming an IBC, doing business and getting around their local tax laws, right? So they say, okay, great, you can have that company so long as you don't do business locally. And it's something similar in the way that Gibraltar's taxes are set up. So they have non-resident companies, first of all, because it's only based on management control. So where it's managed and controlled is where it's tax resident, and they don't go and enforce abroad. The other country enforces abroad. But also they have a remittance-based tax system and sort of quasi-territorial tax system. So you basically end up in a situation where you can't do business in Gibraltar, right? But it's a tiny little place. Usually people don't mind not doing any business in Gibraltar because how large is the Gibraltar market anyway, right? So this is quite an interesting opportunity for people if you want to have gain access to, say, the financial infrastructure of a given region, in this particular case, the EU. Potentially you want to gain access to payment processing rates, things like this. These companies often appear a little more white, I guess I would call it. They're kind of mid-shore jurisdictions as opposed to pure offshore jurisdictions. And that can sometimes be useful. Historically, it was quite easy to get bank accounts in Cyprus. Now the quality of the banking from a stability and safety standpoint is obviously questionable because, back in 2011, 2012, you had a bunch of problems. And then on top of that, afterwards, you had FBME went down. And since then, it's become much, much more difficult, or just actually in the last year or so, it has become much more difficult to bank there at all. They've kind of been kicking out a lot of their customers unless you actually have real presence. And so, it's debatable how useful it is today compared to what it was. But where I think it is especially useful is if you want to access the European payment processing market and do that with, potentially zero tax, right? Similar thing from Gibraltar, but it's harder to bank with a Gibraltar company than with a Cyprus company is generally what we find. Even though Gibraltar was a little bit nicer in terms of the annual filings, there was less requirements, a little bit easier. You didn't have to deal with Greek, you could deal with English, some of these things that made it a little bit easier. Anyway, so the bottom line is that it's worth noting that you want to pay attention to, are there things you can do with residency that can make you double non-resident, that can help to give you the advantages of a place without some of the disadvantages. And that goes based on the fact that the tax rules are different than, say, the payment processing rules, right? These don't necessarily match. They have different sets in terms of how they look at it. And so you can sometimes benefit from one thing without having to worry about the other, and so on and so forth. So anyway, that's a brief overview. It's just basically this concept that you could have a company that's registered somewhere, but isn't necessarily subject to the tax rules in that place. And that can be useful. Again, IBCs are a lot less useful today because it's hard to get banking for them. And in general, this is gotten quite a bit harder, but it's a useful concept to understand. And so when somebody asks, is Cyprus a zero tax jurisdiction? No, it's not, but they do have the possibility of having non-resident companies, and if you have a non-resident company, then suddenly you're in a situation where you can take advantage of the benefit, which, by the way, a really rare situation is Malta, where Malta allows you to manage these foreign companies without being in a situation where you have to trigger the tax residency rules. So that's, again, kind of interesting. And there's a couple places similar to that. Israel has something like that with respect to their trustees and so on and so forth. So anyway, if this is interesting to you, please, like the video, subscribe, write to us. You can check out offshorecitizen.net, offshorecapitalist.com, and look at our other articles or other videos. And I will look forward to seeing you guys on the next video.